Central banks once counted on the United States dollar as the backbone of the global system. Now its share of world reserves has fallen to just 56%, the lowest in a generation, while gold prices have exploded 66% in a single year. What is driving the world's most powerful banks to dump dollars for gold at record speed? And what hidden crisis is forcing their hand? Here is where the unraveling begins. In 2001, the US dollar made up 71% of the world's allocated reserves. By mid-2025, that number had fallen to just 56.32%, according to the IMF. This decline is not a sudden reaction, but the result of a steady, decades-long shift, tracked by the IMF COFER database. Each quarter, central banks report their official holdings to the IMF, revealing how the world's reserve managers are quietly rebalancing their portfolios. The data shows a clear pattern. The dollar's share has dropped nearly every year since its peak at the turn of the century. In 1994, the dollar's dominance was unquestioned. But as new currencies like the euro and yuan gained ground, and as global trade patterns evolved, the dollar's grip began to loosen. Central banks responded by diversifying their reserves, adding more euros, yen, and most recently gold. The pace of this shift is striking. If the current trend continues, the dollar's share could fall below 50% by 2034. This is not just a statistical milestone. For reserve managers, the decision to hold fewer dollars is about reducing risk, whether from inflation, sanctions, or political uncertainty. IMF economists point to this as a structural adjustment, not a temporary move. The numbers tell a story of growing caution and a search for stability beyond the dollar. As the data unfolds, the motives behind diversification become harder to ignore. Gold's rally in 2025 was historic. By October 2025, the price had shattered records, breaking above $4,000 an ounce for the first time. Over the course of the year, gold climbed 66%, outpacing nearly every other major asset. Silver surged even more, rising 142%, as investors and institutions scrambled for exposure to hard assets in a world of shifting reserves. Market strategists at major banks took notice. J.P. Morgan released a forecast calling for gold to reach $5,000 per ounce by the end of 2026, while analysts at Bank of America suggested that even higher numbers were possible if current trends held. The World Gold Council tracked the surge, noting that central bank purchases remained strong even as prices soared. The Council's reports showed that official sector demand was not just a footnote. It was a key driver behind the price action. Trading desks pointed to a new dynamic. Gold was no longer just a passive reserve. It had become an active target for accumulation. With central banks and sovereign funds leading the charge, the pace of buying compressed available supply, pushing prices higher and forcing private investors to compete with state actors. In interviews, market analysts described a feedback loop. Rising prices fueled more buying, and more buying fueled rising prices. This was not a speculative bubble driven by retail traders or exchange-traded funds. The numbers made clear that institutional demand, especially from governments, was reshaping the market. As the year closed, the conversation on trading floors shifted from whether gold could hold its gains to how high official buying might push it next. Inside the People's Bank of China, reserve managers have spent the last decade quietly overhauling the nation's balance sheet. Between 2013 and 2025, China slashed its holdings of U.S. Treasuries by nearly half, dropping from $1.317 trillion to just $730.7 billion. This was not a knee-jerk reaction to market swings, but a calculated effort to reduce exposure to the dollar. Each month, PBOC official releases confirm the same pattern. Treasuries down, and gold up. By September 2025, China had added gold to its reserves for 11 consecutive months, pushing total holdings to 2,298 tons, now valued at $283 billion. Gold's share of China's reserves climbed from 1.8% in 2015 to 4.9% in 2025. PBOC officials have rarely commented directly on their motives, but analysts point to a deliberate strategy: insulating China's financial system from sanctions risk, from inflation, and from the political leverage that comes with dollar dependence. The scale and consistency of these moves have made China the reference point for other central banks seeking to diversify. Across the global south, central bankers from Brazil to South Africa began working in concert. By late 2025, the BRICS nations, Brazil, Russia, India, China, and South Africa, held more than 6,000 tons of gold between them, accounting for over half of all central bank gold bought worldwide since 2020. The pace only accelerated, with nearly 800 tons added to their reserves in 2025 alone, according to official communiques. These coordinated purchases were not about speculation. They were about building a foundation for a new system. On October 31, 2025, the BRICS Secretariat announced the launch of a pilot settlement instrument called the Unit. Designed for cross-border trade, the Unit is anchored 40% in physical gold and 60% in a basket of BRICS national currencies. Its value recalibrates daily, tracking gold prices and currency moves, and it operates entirely outside the US dollar system. By December, a working prototype ran on a permissioned blockchain, with each unit tied to a precise mix of gold and currency reserves. For the first time, a major economic bloc had tested a digital settlement rail that bypassed both the dollar and SWIFT, relying instead on their own gold-backed infrastructure. The message was clear. This was not just diversification, but a coordinated challenge to the long-standing order of global finance. Poland's central bank took center stage in 2025, outpacing every other country in official gold purchases. The National Bank of Poland added 83 tons to its reserves, the largest annual increase by any central bank that year. Governor Adam Glapiński's team raised their gold target from 20% to 30% of total reserves, a move that sent a ripple through regional financial circles. The decision was not made in isolation. Across Europe, other central banks followed Poland's lead. The Czech National Bank extended its buying streak to 30 consecutive months, steadily building a stockpile as a buffer against currency shocks. Further south, Serbia's finance ministry announced a plan to double the nation's gold reserves to 100 tons by the end of the decade, citing the need for greater security in uncertain times. These moves were not about speculation or headline chasing. They reflected a deeper calculation. If the world's largest economies were hedging against dollar risk, smaller nations saw little reason to wait. The gold rush had clearly spread beyond emerging markets, confirming that this was now a global phenomenon. By December 2025, the Federal Reserve faced a financial landscape shaped by mounting pressure. The national debt had climbed to $37.4 trillion by September 2025, with Congress raising the ceiling to $41.1 trillion just months earlier. Interest payments alone now consume more than 20% of federal revenue, a burden not seen in generations. In this environment, the Fed's policy decisions drew sharp scrutiny. While officials maintained that balance sheet reductions remained the priority, critics inside and outside the central bank began to question whether routine liquidity operations were masking a deeper problem. Short-term Treasury bill issuance soared, and the Federal Reserve's ongoing interventions in repo markets pumped billions into the system. Some commentators argued that these measures blurred the line between market support and debt monetization. For reserve managers abroad, the numbers told their own story. America's fiscal trajectory and the Federal Reserve's response were fueling anxiety about the long-term value of the dollar. Custodians in the bullion market are facing a test of capacity not seen in decades. The World Gold Council projects central banks will acquire 585 tons of gold every quarter through 2026, a pace that strains the logistics of global vaulting and insurance. Each new ton requires secure storage, compliance audits, and specialized insurance, all coordinated across continents. Vault operators in London, Zurich, and Shanghai report near full capacity as state-level demand crowds out private clients. Insurance premiums for large shipments have doubled since mid-2025, reflecting the risks and complexity of moving so much metal in a compressed time frame. These operational hurdles have become part of the price equation, keeping gold elevated even as volatility rises. With official sector buying set to remain strong, the market is running up against the physical limits of what can be sourced, shipped, and safely stored, leaving little slack for any sudden surge in demand. Gold is no longer just a relic. It is an active weapon in a global currency standoff. As nations move reserves out of dollars and into bullion, every shift signals new uncertainty for markets and savings alike. The next move in this monetary contest could rewrite the rules. What is your take?